All right, so this is gonna be just like series of lectures, just on like some background knowledge, just for some of the people who are remote, and then we might also release this to the public. I'm wearing this goofy mic because I'm worried that my iPhone's quality is not going to be good enough, at least with like the fans going on. So I'm going to talk about limit order books. Limit order books are essentially what we use to keep all of the buyers and sellers who are currently interested in a particular security. That security could be like cryptocurrency, stocks, commodities, it could be whatever. And security is really just a general name for anything that's financially tradable. So let's say we're trading like Costco, and Costco is trading for $50. But we need to think about, what does that mean for Costco to be trading for $50, right? Well, there needs to be buyers and sellers, and they might not always be at exactly $50. That just might be the last price that a trade was executed at. And so what a limit order book looks like is it's really something like this, where you have a bunch of different price levels closer to like this midpoint, this mid-market price. And so maybe the mid is like 50, then you'll have like 49, 48, 47, 51, 52, and 53. And so there'll be different price increments. And maybe for something that's a little less traded, it'll have big price increments like this. But for Costco itself, it might actually have really small increments. They might be in cents. So it might be like $200.01, $200.02. And so you've got your sellers up here and your buyers down here. And that's because the sellers want to sell for more money and the buyers want to buy for less money, right? And so at each price level, we're going to have a certain amount of what's called liquidity. And liquidity is essentially the amount of that particular security that's being offered to buy or sell. So for example, at $48, we might have 6 shares of liquidity. That means that there's a total of 6 shares of Costco being offered at $48. And then at $49, maybe there's only like 1 share of liquidity. But $47, that's like a pretty good deal, right? That's like $3 off from what the mid-market price is. So maybe there's like 100 shares, and it goes onwards. And then at the top, we're going to have the people who want to sell the stock. And so then, of course, it's a bit of a mirror pattern where you have like more liquidity up here. It doesn't always have to be balanced, but it like decreases as we get closer to the mid price, right? And so a key thing to note here is that there might not actually be any liquidity at exactly what's quote unquote like a fair price, right? Or the mid price. There's something called a spread, and that's the difference between the price someone's willing to sell at and the price someone's willing to buy at. And so this is called the bid, and then this is called the offer. Okay. And then the NBBO is the national best bid and offer. National meaning across like all exchanges. So the NBBO. And so when we talk about the spread, that could be for a particular exchange. Like for example, Costco could be traded on the NASDAQ, but maybe it's also being traded on the NYSE. The NBBO is the best across all exchanges. And then when we're talking about spread, we're usually talking about the NBBO spread, rather than the spread on a particular exchange. So the next thing to be wary of in the order book is how executions work. So if you want to buy a stock, you might notice that you can't fill your entire shares if you are looking to buy a lot of it, right? So if you're trying to buy like 1,000 shares of Costco, we're gonna have to eat deeper into this order book to get to those 1,000 shares, right? So we'll eat the 2 shares, but then we have to pay more if we want to get another 15, and more if we want to get another 30, right? We got to go up to like 53, more and more money. And so then the average cost, which is also a weighted average, I'll note, it's like 2 times 51 plus 15 times 52 divided by the total number of shares. The average cost is going to increase as we take more liquidity from the market. All right. So I think that kind of explains like how limit orders work, but I think something more valuable that I can give to you is the mechanics of microstructure. And microstructure is just a fancy word for talking about how buyers and sellers interact in a marketplace. And so one example of microstructure would be the imbalance of an order book. So this order book, maybe a bit balanced, but when I talk about balance, I'm talking about the volume for offers and the volume for bids. And so if we graph the volume, and you'll see this in like different trading platforms sometimes, but if this axis here is your liquidity, which is like, I think volume is like actual executed trades. Liquidity is the potential for execution. So if liquidity is on this axis, and then on this axis is price. So like maybe this is our imaginary like mid price, which might usually be around the NBBO. Just making sure I'm recording. Yep. Which might be around like the NBBO, and the price goes up and down. So there's lots of people willing to trade at huge discounts, right? So it's like if the stock's like for $50, right, and then up here is like $100, everyone's like, yeah, sure, I'm willing to take a 2x gain on my shares. So maybe like there's a ton of people out here that are willing to trade, right? And then the same deal for buying, right? Lots of people are willing to buy this stock for like $1, right? And it could be a cryptocurrency, it could be gold. Like this applies to everything. I'm just using stocks because it's a model that a lot of people understand. And so, maybe there's like a lot of people here. And the idea is, generally speaking, not always, but there will be decreasing amounts of liquidity as you trend towards the mid price. And there are other reasons for that we'll get into. And so basically people will have something like this. I say people, I mean like market participants. And so this is where like real trading is going on. And then everywhere else, these are just people like adding liquidity to the market. So one reason liquidity even exists is because of the fee structures and the rebate models of modern exchanges. So modern exchanges generally charge you whenever you trade on their exchange. So for every share of stock you execute on their exchange as a member of the exchange, you're going to charge like a few cents on every share. Now that's different from like a regular commission. So like CIBC or some other stockbroker might charge you like $6 a trade. But at the underlying level, that's not actually how the fee structure works. So the underlying fee structure of stock trading, and now this is specific to stocks, but the microstructure stuff will be generalizable to like cryptocurrency and other things. So for just like execution for stocks, let's say you're CIBC over here. Actually, CIBC is a bad example. Let's do like Wealthsimple or something. But Wealthsimple doesn't have commissions, but we'll say Wealthsimple has commissions. Okay. Wealthsimple's over here. So here's you're a retail trader. Retail trader just means you're an individual. You're not like a financial institution. You're not like a hedge fund, nothing like that. No big money, no direct special things going on. You're just a person who wants to buy a stock. So you connect to your broker, right? And your broker will generally be like what's called like a discount broker. And that's just a broker who their business model is to interface with lots of small accounts, right? Like you. Small accounts being, I don't know, anything less than millions of dollars. Because in finance, there are trillions of dollars. So the orders of magnitudes are kind of shifted. But when you're interfacing with Wealthsimple, they're not actually a member of the exchanges they want to trade on. Because in order to actually trade on a particular stock exchange, you need to be a member and you need to pay an annual fee. Like for example, the NYSE's annual fee is $1 million a year to be a member. That's quite expensive, right? So it's not like if you want to trade stocks, you're just going to put in $1 million and now you're trading stocks, right? So what Wealthsimple would likely do is talk to a liquidity provider. It's called an LP. They might even talk to an aggregator of LPs, but we'll get into that in a second. So what a liquidity provider does is they essentially are willing to execute for them, either directly or indirectly. They're just going to take your order flow and then make sure it gets bought and sold for the particular prices that you're interested in. So LPs, there's lots of LPs in the world. Some of them are companies, some of them are like hedge funds. So like Citadel is an example of an LP, right? So there could be like a Citadel, there could be like an IMC, I don't know, like an HRT. So there could be all kinds of like hedge funds or high frequency trading firms that are also liquidity providers. So they will execute your trades for you. And so essentially what happens here is you'll have like a bunch of exchanges, NYSE, maybe like the NASDAQ. There's also like the ARCA exchange, which is now part of the NYSE, but that's for ETFs. And so each of these exchanges have varying fee structures, and they also have different memberships. So to execute on all the exchanges, you might need to pay a significant amount of fees, right? Like for the New York Stock Exchange, it might be $1 million, right? Maybe it's like another million, maybe it's like 800K for NASDAQ. Maybe it's like another 800 for ARCA, right? You got to pay all these fees. And so generally, these like direct LPs, they will have direct access to the exchanges, right? Like Citadel will be a member of all of these. HRT will be a member of like a few of these, right? And so what they can do is they can access, first of all, the direct fee structure, which is like much cheaper than what everyone else is charging, right? They're charging cents per share or fractions of a cent per share. And then they will pass that service on to like different brokerages, right? Or just like institutional clients, institutional just meaning big amounts of money. And then they pass that on to you for like a flat fee or something like that. So they do profit quite a bit on your commission. Like the commission charge on your stock particularly, if it's $6, like maybe it costs them a cent or a few cents to actually trade that. But they do have to pay, or they might not even need to pay the LP because the LP is making money off of your orders. So yeah, that's why commissions are going away, because you don't actually need to pay commission because Citadel's already making enough money trading against you because they're just way smarter than you and they're making money off of you. So what's going on here is, so this is like kind of the general structure of, how you get to a stock exchange and what it means to be a member of an exchange. And now if you're a direct member of an exchange, you also get to participate in something that's called rebates, liquidity rebates. And so that's more pertinent to this limit order book stuff I was talking about. And so the deal with liquidity rebates is in regards to just improving the microstructure of your own exchange. You want to encourage more trading to happen, because if you have a limit order book and you're in the limit order book, right, if the price moves vastly against you, like you might get taken out and now you're at a big loss, right? You might have just bought a stock that's falling down, 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 and you're taking a lot of risk. And so what you might think is that it's better to just take away liquidity than to add it. Because like what's in it for you by having resting orders on the market, which is to say orders that are just sitting out there that other people can take. And so your limit order book would probably start looking like this. It's just empty, right? Or maybe there's like a little bit of volume here, right? Like a little bit of liquidity, but it's just like these super huge spreads and also like no volume in the exchange. So anytime someone comes along and they want to buy or sell, there's just this massive gap, right? Like no one's making markets. And so like, how do you encourage markets to be made on your exchange? You provide something called a liquidity rebate or a fee rebate. And what happens there is if you make a market, so if you put out an order and wait for it to be taken, you are paid by the exchange. Whereas if you take an order, if you're a taker, so you say, oh, I want to buy this, and you take away liquidity, then you have to pay. And so the fee structure on exchanges can look a couple of ways. They might, and the fees will be tiered. So the more you trade, the lower the fees get. And in some situations, eventually you don't pay any fees. So after you've paid the exchange like $10,000, you end up not paying them anymore. And it's just because like, it'll be like, oh, on the first like $1 million you trade, the fee is like 0.2%. This is actually real. This is like Kraken.com's crypto fees. And then on the next, like, Kraken's 50K here. In stocks, the numbers are a lot larger. And then like maybe on the next like 10 million, the fees are like 0.16%, right? All the way down to like you're trading like $1 billion and that's like 0.02% or something like this. And so then like by getting down to here, it works out to like a flat fee. Because like, even though these are percentages of this, because there's a point at which you reach like a kind of floor, like a fee floor. And if that floor goes to 0, you're essentially just paying a certain amount of money to be allowed to trade for free on the exchange. So that's just on like tiered pricing. And so the way that maker taker fees are looking is, one way it could be, you've got the maker here, you've got the taker here, and they just pay equal fees. And by making them pay equal fees, you're not really incentivizing a full limit order book. But what you can do is by decreasing the maker fees, which is to say, if you're not immediately filled, if your order is resting out there and it's not immediately filled, then you pay less money than the takers. And so this is like asymmetric fee structure. But then what a rebate is you're actually paying negative fees when you put out these resting orders. And so by paying negative fees, you're actually getting paid just for providing liquidity, just by putting up your money and saying, here, I'm willing to buy at this price. And this is actually what a lot of quantitative trading firms make money off of. And this is why it's profitable to be a market maker, is because just by being on either side of the market, by having orders here and here, if someone hits you here, well, you just made some money for free. And as long as you can hedge it without it moving more than this amount, then you're in the clear, you're profitable, right? And I won't get into like the complexities of like hedging specifically, but you have to be wary of the costs of your hedging as well. But if you're able to hedge for a cheaper cost than this rebate, then you can essentially turn a profit. And so this is what fee rebates look like. And so that's the reason why there are lots of these orders sitting out here, because these people are happy to be filled at these different prices because they're just going to get paid. So another thing I want to talk about with limit order books is limit order book asymmetry. And so that's something where it's not always balanced like this, right? So if a lot of people are trying to sell a stock, you might have something that's called a sell wall. And a sell wall is really just an asymmetric book that looks like this. And so you can see that the price is going to have a hard time moving up, simply because no matter how much volume you throw at it, you're quickly going to hit this stop where it would take like gazillions of dollars, right, in order to move the price up anymore. Whereas to move the price down, it would not take that much money, right? Like the sum here, it might take like if you add up all of the area under this curve, maybe it's like $1 million. Whereas if you add up the area under this curve, it might be like $100 million, right? And so that's a sell wall, and that's also the idea of an asymmetric order book. And so like maybe for like a $2 move up, it would take 100 million, whereas like to move $1 or $2 down per share, it would only take like $1 million. And so if someone comes in the market and they decide, oh, I want to sell, well, that could push the price down super fast if they want to sell all of that all at once. Now, that being said, there are a lot of institutions like Citadel and IMC and proprietary trading firms like Jump they work very hard to try to execute those orders efficiently so that you don't destroy the liquidity in the order book. And that's something that's interesting that you might want to work on. But yeah, just like if you were just to come in the market and just dump your order, it would completely destroy the price. Your average fill price would be super low. It would be terrible. So that's one way an order book can look. I mean, order books they don't always have to look like that. Like maybe it just is a little asymmetric. So it could be like this, whereas like that, like you could have something like that. You can have more of these block orders, and these block orders are usually just like institutions or someone where they're just like, they're willing to buy or sell like a large amount at like one price. And that's why you see these like chops. So like this is more like, diverse flow of people who care about all these different little prices. But then as you get farther away, it's generally just someone like, okay, at like 100% discount, okay, that's for free. At like an 80% discount, I'm willing to put up like $10 million or something like that. Okay, so that's a little bit on limit order books. And also just like providing liquidity and how money is made that way. I will say that you should not always trust what the limit order book says, because a popular method in trading is called spoofing, and that's putting orders in the order book that you don't intend to have filled. And so what that can look like is it can make it look like, for example, there's a sell wall, but then right as people are going to take out that sell wall, it goes away. So for example, if you have an order book that looks like this, right? This looks like a sell wall. And so what might happen is the price will get pushed up and up, right? People are getting filled here. So there are trades going on the tape, right? So there'll be a trade, it'll be like $50, it'll say like NYSC, and it'll say who like traded it. Like maybe it's like Citadel. And it'll also say the amount. So it'll be like 1x, 1 share, 3 shares. Right? Like 3 shares. And so this tape will be coming, and then this will be moving, right? Just like the smallest amount. And then what might happen is just as we're about to reach this massive sell wall, it'll all of a sudden disappear, and instead the LOB will just look like this behind it. It just like disappears. Where did it go? And it's because it was a spoofed order, right? It was a fake order. And they just wanted to make it look like the price was going to go down, but maybe that's because they were actually interested in buying. And so then once they're about to get filled, they take that order away. And so someone asked today at a meeting, is spoofing illegal? Well, yes, technically. But the thing is, a lot of these trading firms, it's about technicalities, right? Like maybe they can say that they really did intend to have this filled, but then something happened in a certain market and they were managing risk. And so by managing risk, they were getting rid of this. Fun fact, that's actually what a lot of the banks said in the financial crisis. Like Goldman Sachs was really heavily scrutinized for selling a bunch of terrible products to their clients. People said it was a conflict of interest. Goldman Sachs said they were managing risk. They saw risk in the housing market, they managed it, and they sold it. Because Goldman Sachs has trillions of dollars under management and billions in profits, they can pay an army of lawyers to defend their argument that we're indeed managing risk. Whereas, someone like you or me might not have that ability. So I wouldn't always trust what the order book says is kind of the lesson here.